financial advisors, planning for life. Wealthway Financial Advisors, planning for life.
And good evening, Hampton Roads. Welcome to another edition of Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm your host, Certified Financial Planner Kevin Zivna, coming to you live like I do every second and fourth Tuesday of the month to dialogue with you, take your calls. If you have a question or comment relating to your own personal financial situation or anything I'm talking about here tonight, jump on the phone lines, give me a call. All we need is your first name, city you're calling from, and no matter what I'm talking about, if it's important to you, then it's important to me. We'll get you right on air. 627-7979. That's 627-7979. Wealthway Financial Advisors is the proud sponsor of Dollars and Common Sense. We are an independent registered investment advisor, which means we're legally held to a fiduciary standard to put our clients' interest ahead of our own in any business dealing or recommendation that we make, and that's the way it should be when you decide to partner with a financial advisor. As the premier financial planning firm in Hampton Roads, we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. So by design, we can't work with everyone. We work with a relatively small group of high net worth individuals, but that's one of the reasons we feel so strongly about coming here every second and fourth Tuesday at 6 p.m., and that's to reach out and help as many people in the Hampton Roads listening area that we can achieve your measure of financial success, because it is a core belief at Wealthway Advisors that the overwhelming majority of people in this country have the opportunity for financial security if they choose it. And it is a choice because it takes some time, it takes some effort, and it takes some knowledge. We are here to help. You got to take that first step, though. Pick up the phone, give me a call, 627-7979, whether you want to talk about anything having to do with the investment markets, the economy, insurance products like life insurance, health insurance, property casualty, taxes, tax planning, tax reduction strategies, retirement planning, retirement plans, 401ks, 403bs, TSPs, 457s, mortgage options, Social Security claiming strategies, or estate planning, wills and trusts. All that and more falls under the umbrella of personal finance we are here to discuss tonight. 627-7979. All right, here we are at the end of November. Happy Thanksgiving, everyone. Hopefully you've held off on the Christmas lights until this weekend, and we're looking forward to turkey and pumpkin pie come Thursday. So we are at or near the end of the year, and so it's time for our annual financial planning issues to consider at year end. Some final last-minute moves that you can make to set yourself up for financial success, not just this year, but into next year and beyond as well. We'll talk about some asset and debt issues, tax planning strategies. We've got a bunch of those to consider before the year is up. Then we're going to talk about some cash flow issues, insurance planning, estate planning, if time permits. And if it does not permit, then we'll probably have segment number 2 of the show in 2 weeks on the next show, December 9th. So year-end financial planning issues. But before we get into that, as promised, when we have the caller on the line, we're going to break out of the script and into the call. So we have Alina in Virginia Beach. Good evening, Alina. You're on Dollars and Common Sense.
Hi. Thank you so much for having me. I've heard you before, and I appreciate you taking the time. I started a new job last year in December of 2024. And I just now realized that they have not been putting any money towards my 401k. So we're obviously in November. It's the end of the year. I'm an accountant. Obviously, I should have taken care of this earlier. But if I put more money into my 401k, is it still tax deductible or no?
So the short answer is yes, Alina. First off, let me clarify a few things. You said your employer has not been putting money into the 401k plan. You mean that you have not been withholding money from your paycheck and putting it into the 401k plan?
Correct. And the small caveat is that within the middle of the year, our company was sold to another company. So that might have happened in that transition. Not exactly sure, but correct.
Okay, but they have not been taking it out of your paycheck and not putting it into the plan, right? It's you just haven't been having it taken out of your paycheck.
Correct.
Okay, that's fine. It sounds like you just kind of like things got lost in the shuffle there. So the short answer also to whether you can contribute like the full amount for this year, $23,500 if you're under age 50, or another $775,000 if you're over 50, for a total of $31,000. That's the maximum contribute limits for most people this year. If your employer will allow you to do that, then yes, you can try to cram as much into the 401k plan before the end of the year as your employer will let you. Sometimes that's a very viable strategy where people wait till the end of the year, especially kind of like in sales jobs, to see how the year turns out. They had a good sales year. Then they'll take the last maybe quarter and take all their paycheck, 100%, of the paycheck, and put it into 401k plan. So just know that that's possible, but it will also come down to plan design. How was your 401k plan set up, and what your employer's payroll, HR will allow you to do. But technically, it is possible.
Okay, so it is possible, but hypothetically speaking, let's say I'm not allowed to do that at all.
Mm-hmm.
Let's say I have to do it on my own.
Well, no, you couldn't contribute to the 401k plan on your own. You have to go through your employer in order to do that. What you can do is contribute to an IRA on your own directly if you are eligible. Now, of course, you can't contribute as much to an IRA as you do in a 401k plan. Maximum there for this year, $7,000, unless you're 50 or older. Then a total of $8,000 is what you can contribute to a traditional or Roth IRA.
Okay. Well, I do have an IRA with the former employer, so technically I could put money in that. Is that still tax deductible though?
If it is a traditional IRA as opposed to a Roth IRA, do you know that if it's?
Gotcha.
Do you know which type it is?
I believe it's just a regular traditional, the kind where they take it off your taxes up front, if I'm correct.
Yes. Okay. Well, if it's a traditional IRA, then you have till you file your taxes, technically April 15th of 26 to make the IRA contribution, unlike your 401k, which you have to make those contributions by December 31st. So you have a longer lead time for the IRA. $7,000 unless you're 50 or older, up to $8,000. Now there are some income eligibility limits that might prevent you from making the full contribution or total contribution. For a traditional IRA, if you are single, your modified adjusted gross income needs to be $89,000 or less. If you are married filing joint, $146,000 of modified adjusted gross income or less allows you to make a full IRA contribution.
That's awesome news. Thank you so much.
All right. Well, thanks for the call, Lena. Appreciate it, and good luck to you. Make sure you're doing the right thing. You're trying to put away enough money for your long-range retirement as you can, and while it didn't go exactly according to plan this year, looks like you still have an opportunity to get some money into either 401k and or an IRA. And so that's what we're going to be talking about tonight, some last-minute moves that you can make before the year is up. All right, we have another caller on the line. We're going up to Hampton to speak with Alan. Good evening, Alan. You're on Dollars and Common Sense.
Yep. Greetings here from Buckrow Beach. Love the show. Look, I'm going to try not to get in the weeds here. I'm going to make this quick. I'm going to try. Now, this has nothing to do with me, but it has to do with my longtime girlfriend. Her mom and dad had a will, many years ago, and then her mom passed away, sir, like maybe 2.5 years ago. And she said that her dad, who is still alive, he's 88 years old, after 1 year, she gave her dad a ride down to the lawyer's office, and she had to sign a couple of things, but she believed that her dad had to take her mom off the will because she had passed away. But she's not sure if that's exactly what happened. Mm-hmm. But anyway, sir, about 8 months ago, she had a younger brother, and he up and accidentally passed away. And he's on the will, but further down. But she got moved up right behind her dad, who's still alive. But we can't figure out why deceased people, if they're deceased, why it's very important to take them off the will, and how do things like that work out? We're just trying to figure that out, sir, and I'll take your comments off the air.
Mm-hmm. Okay, all right. Thanks for that background and explanation, Alan. I think I can take it from here. Yes, you don't have to. When we create a will and we list our heirs who we want to receive our money when we pass away, typically, most cases, we're going to name our spouse number one, and then usually kids are number two behind the spouse. And obviously, it might not go exactly in that order, and that's perfectly normal and natural. And sometimes the distribution of the estate is not entirely equal among all the parties, all the inheritors. And that can be all normal and natural as well, and there can be good reasons for doing that. So when you have a will and you name heirs to receive items of value from you, and they predecease you, then there is an orderly distribution plan set up, largely by the state of Virginia, to ensure that the money then goes to the next in line on that will, or as it is designed by the attorney who did, or I guess anyone can do it. You don't have to have an attorney, but we certainly recommend that you do. So when somebody predeceases the person who makes the will, then there is a distribution path to do that. However, it is a good practice when that happens to go ahead and get your will updated, and that eliminates any ambiguity and any gray area to introduce itself into the will document, and then if it goes to probate, which a lot of them do through the probate process as well. So it's not something that has to be done, but it is something that should be done, and it just helps keep that legal document in tip-top shape so that the money does ultimately flow through as quickly as possible to the person that the will maker intended to have that money. So sounds all normal and natural. Doesn't sound like anything is out of line in that setup that you described there, Alan. So appreciate the call, and hopefully that was helpful to you. All right, we're going to pause right here for a short break. 627-7979. I'm Certified Financial Planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm Certified Financial Planner Kevin Zivna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can look us up online at wealthwayadvisors.com. All right, talking about year-end planning issues. A couple good calls already, and if you want to jump in on this conversation, or if you have any question or comments relating to your own personal financial situation, 627-7979. All right, let's talk about some of the asset and debt issues that come into play at the end of the year. So as it relates to some investment activity, If you have any unrealized investment losses in your taxable accounts, you might consider realizing those losses to offset any gains that you had throughout the year and or write off up to $3,000 of ordinary income. All right, so what's going on there? So first of all, there probably aren't too many people that have too many losses in their, these would be your taxable brokerage accounts or taxable mutual fund accounts. This would be money outside of an IRA, outside of a 401k, outside of the TSP, outside of company retirement plans. So you're either investing through in a brokerage account, say at a major custodian like Fidelity or Vanguard, or you're investing directly in mutual funds or ETFs with the manufacturer of those funds, like maybe T. Rowe Price or MFS or some other big providers as well. So if you have them in what we would consider a taxable brokerage account, and you have a loss, but you haven't sold yet at a loss, you can intentionally sell that investment for a loss, realize that loss, and then use the loss to offset other investments that have a gain this year, or write off $3,000 of that loss against your ordinary income, which is actually fairly valuable if you're in a higher tax bracket. So just know that that's an option. It is a little bit more of an advanced maneuver. Once you sell that investment at a loss, then you have to wait 30 days before you can buy back in order to fully claim that loss. So there's some technicalities here, and you should probably know what you're doing, research what you're doing, or work with a professional to do this. But it's called tax loss harvesting in our world, and it can result in some short-term tax savings. Long-term, depending on the amount, it might not move the needle too much. And again, over the last 2 years, we've had really good investment gains broadly across the U.S. stock market. So there's probably not too many people who have too many losses in taxable investment accounts. Okay. How about do you have any investments in those taxable brokerage accounts that are subject to end-of-year capital gains distributions? If so, you might be able to tweak that a little bit to minimize the tax liability. So one of the things I said, do that if you have some. So basically mutual funds, at the end of the year, a mutual fund is a basket, and inside that basket can be anywhere between, say, 25 or up to 1,000 individual securities, stocks, bonds, all kinds of different instruments in a mutual fund. And at least once a year, if the mutual fund had a profit for the year, then it needs to distribute some of that profit to the fund shareholders. So that comes in the form of payouts of dividends, interest, and capital gains. And each of those can be taxed a little bit different, but they are all taxable unless the activity is in a tax-protected account like an IRA or a company retirement plan. So if you have some mutual funds that are going to pay out this year, chances are they are going to pay out, you are going to get a distribution this year, whether you want it or not, because unless something radically changes here in the next few weeks, most mutual funds are in a gain position, so they will be paying out distributions. So one of the things you can do, again, a more advanced maneuver, and we got to be careful not to let the tax tail wag the dog. So you don't want to do this just to avoid taxes. But if you have some investments like a mutual fund in a gain position, if you sell it now, then you will realize a capital gain, but capital gains are taxed at a lower rate than interest or dividends distributed from those mutual funds. So the capital gains for most people, capital gains rate is 15% for most people. Could be 0, could be 20% also, but for most people it's 15%. And also for most people, that is a lower tax rate than your ordinary income tax rate, which might be 22, 24, 32%. So you sell your profitable mutual fund for a gain. You pay capital gains tax rates, so you avoid the distribution of the income and the dividends from that mutual fund. So you're a little bit more tax efficient there. And then let's say you were ready to make a change, or as part of rebalancing your portfolio, take those proceeds from the sale and buy new shares of a different investment. And that's a way of lowering your tax liability before the end of the year. And it looks like I got 1 minute for the break, so I don't want to get into my talk about required minimum distributions because that's a little bit more complex here. So tonight we're talking about year-end financial planning moves that you can make while we still have time. We got about 6 weeks of the year left to go. People who want to make any changes to your company retirement plan, you got to get on that pretty quick. Things tend to slow down towards the end of the year with a lot of people taking time off and vacation, so now's the time to act. All right, we're going to be right back after the news in just a few minutes, so stick with us. 627-7979. I'm certified financial planner Kevin Zibna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zibna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can look us up online at wealthwayadvisors.com. Once there, you can request an information packet to find out what it's like to work with us, or sign up for a free quarterly newsletter at wealthwayadvisors.com. Just go to the Request a Consultation page, put your name and address in the dialog boxes there, select the appropriate drop-down menu, and we'll get that information out to you later. Well, we won't do it later on this week because we got Thanksgiving coming up, but we will do it early next week. We'll get that information out to you early next week, and that's all we will use your name and address for, is just to send you the information that you request. Or if you have some nuanced questions, want to speak to a live human being, give us a call at the office, 456-2200. Want to remind everybody, our next live show will be in 2 weeks on Tuesday, December 9th at 6 p.m. as usual. But if you can't catch us live every second and fourth Tuesday of the month, get this show as a podcast. Search for Dollars and Common Sense wherever you get your podcasts. Download us, take us with you where you go, and listen at your convenience. And for those of you into social media, we have a presence on Facebook and LinkedIn. Search for Wealthway Financial Advisors. Hit that like or follow button. And once every week or two, we put up an interesting and informative financial planning post to keep you engaged in the process. All right, tonight, talking about financial planning ideas, moves to make before the end of the year. Before the break, I was talking about, or about to talk about, a required minimum distribution. So there's some strategies around required minimum distributions that come into play towards the end of the year. So what are required minimum distributions? Well, people who are age 73 this year or older have to take a required minimum distribution from their traditional IRAs or from their company retirement plan if their 401k, 403b, TSP is still with their previous employer. So people who are subject to RMDs, as we call them for short, here's a little tip for you that can maybe make the administration a little bit easier. if you have multiple IRAs that are subject to required minimum distributions, and this can definitely happen for people who leave their company retirement plans behind at multiple employers, or maybe they've rolled over a company retirement plan into an IRA for some of them, but the other ones are still left behind. Point being, if you've got multiple traditional IRAs subject to the required minimum distributions, you don't have to take the required minimum distributions from each IRA. You can aggregate the amount that is subject to all of them and just take it out of one IRA. And that can be helpful if you have a bunch of small IRAs spread out all over the place. Now, you have to do the math, or you have to have somebody do the math for you, or you have to look at your custodian statement that usually tells you if you're subject to a required minimum distribution and the amount. And you got to add it all up, and then you got to make sure you are responsible that you take out at least the total required minimum distribution from all the various IRAs that you hold. But so that gives you a little bit of sort of administrative flexibility to just take it out of one maybe big IRA, as long as you take enough from the other small ones as well. Now, RMDs from employer retirement plans generally must be calculated and taken separately with no aggregation allowed. So like I was in my hypothetical there, it's not uncommon for people to have rolled over old retirement plans into IRAs while still having a 401k or company-sponsored retirement plan with their previous employer. You can't aggregate those. You got to deal directly with your employer to get your required minimum distribution from that employer. And one of the reasons we don't like our clients to leave behind their 401ks or their 403bs or the TSPs at their previous employer, it just makes the administration around multiple accounts like that's much harder, much more difficult, something to stay on top of. Things just don't flow as smoothly that way. So usually recommend that they roll over any old retirement plans into one IRA, one type of IRA. You can have a traditional and a Roth, but one type of IRA, get the right money in the right IRA, and then deal with your required minimum distributions from there. But that's coming up. You have until December 31st to make your required minimum distributions if you are subject to them. Again, age 73 now or older. And if you don't do it by the end of the year, while the penalty has been reduced with recent tax law changes, it's still pretty significant. For most people, it's going to be 25% of the amount that you should have taken out. If you didn't take it out, 25% of what you should have taken out, or if there's some exceptions, then you might be able to negotiate that with the IRS down to 10. But still, an unnecessary penalty that you shouldn't even have to deal with if you organize your accounts and your finances properly. All right, let's get into some tax planning issues because we still have a little time on the calendar, and I'll go with my normal disclaimers. Tax planning is not best done at the end of the year, although that's when people tend to do it the most, procrastinate till the end of the year. Tax planning is a year-round endeavor. And in fact, it's not even on a year-by-year basis. Sometimes tax planning moves that you make in 1 year can pay tax-saving dividends for the rest of your life. So tax planning, you need to start thinking about that as a year-round pursuit, not something that is done just at the end of the year, and certainly not on April 14th when your taxes are due April 15th. There isn't a whole lot you can do at that point. So anyway, here we are. Here are some things to think about regarding tax planning. Do you expect your income to increase in the future? And so for most of us, if we're engaged in the middle of our career, each year we're probably going to make a little bit more than the year before, and a little bit more in the year after that, and a little bit more till the end of our career. So for most people expecting an increase in their future, consider the following strategies to minimize your future tax liabilities. So one option is to make Roth IRA and Roth 401k contributions and consider Roth conversions if you're eligible. Also, if you're eligible, consider electing Roth employer matching contributions. So we love the Roth IRA when people are generally young and starting out and new in their career. So if you're in the 20s, in your 30s, and maybe even 40s, it would depend on your career, how much you're making, how long you intend to work. But at least those 20s and 30s, probably the Roth IRA for most people is going to be the most financially astute contribution to make, because you're not in a high tax bracket during that period of time. So the tax break you would have gotten by putting money in a traditional 401k or a traditional IRA, the tax break you would have gotten there, you don't necessarily need when you're in a low tax bracket, because the savings isn't all that great. You know when you need that tax savings? When you're in a high tax bracket. That's when you want your pre-tax contributions in your company retirement plans and those deductible Roth contributions if you qualify for them. So that's how you kind of want to think about how do you manage your tax brackets as your career evolves and as you make more money over time. When you're in the relatively low tax bracket, 10, 12, 22, I'd say even up to 24% tax bracket, then you probably want to strongly consider Roth contributions. If you're above the 24% bracket, you're in the 32, the 35, 37% tax bracket. Now we're talking big money you're sending to the government. So where we can effectively try to lower your taxable income by contributing to deductible retirement plans and IRAs, that's the time you want to do that. So if you expect your income to be larger in the future, significantly so, go to the Roth. If not, then you want to take a look later in your career, typically when your earnings are the highest and you are in those higher tax brackets. That's when you want to make your deductible contributions. So also, again, if you expect your income to increase over time, you want to consider, you also may have the opportunity to make after-tax 401k contributions. Now, you don't get a tax deduction there, but again, if you're in a lower tax bracket, you don't necessarily need it. And it has some tax saving opportunities later on down the road when you take the money out for retirement purposes. And then if you are age 59 and a half or over, you might want to consider accelerating traditional IRA withdrawals to fill up those lower tax brackets that I was just talking about a minute ago. So this is a more advanced maneuver because usually speaking, 59 and a half, you're nearing the last quartile maybe of your career, and you're probably in your highest earning phase. So for a lot of people, this is a hard one to kind of make financial sense for. But people who retire early, say at age 60, and no longer are earning income subject to those higher tax brackets, then you might purposefully, even if you didn't need the money, take some money out of your traditional IRA, which when you do that, it will be taxed as ordinary income. But if you're in the lower tax brackets, the 24 or below, then what that does is it gets that money out at a lower tax rate. And then when you are subject to required minimum distributions, the amount of that required minimum distribution is less than it otherwise would have been because you took out some money in advance. Now, I know that's probably a little technical, might not come across the radio too well. But just know there is an excellent planning opportunity when you're in your late 50s, early 60s. You don't have any earned income, or it's very low, maybe you go to part-time status, something like that, to purposefully withdraw money from your traditional IRAs, subjected to taxation now in order to save taxes later. And that's what I was referring to. Tax planning is a year-round pursuit, and sometimes the actions we take in 1 year can pay dividends over the rest of your life. It's one of the biggest areas of tax savings that we see in our practice, that we do for our clients, and we do a lot of this tax planning now. For years we looked to CPAs to do that, and for years we had our clients complain that CPAs were not doing tax planning for them; they were just doing tax preparation. So over the last several years, we've waded into the tax planning space much more purposefully and aggressively, and are now able to coach and teach our clients certain techniques that they can use to arrange their affairs to keep their tax bracket as low as possible. You can't eliminate taxes. There's this fantasy out there that there's ways that you can make your tax bill go away. No, if you're earning income from anywhere, it's subject to taxation. What we do look to do, though, and we call it being as tax efficient as you reasonably can. And you don't want to let the tax tail wag the dog. You don't necessarily want to make every decision through the lens of tax savings, but where it is, and the reason you don't want to do that is because ultimately most people's goal is to grow their net worth over time, and growing your net worth is going to cause you to realize some taxes through the years. So minimize taxes where prudent, but only where it makes good long-term sense and will contribute directly to growing your net worth over time. All right, got to take our last break. We'll be right back after these messages. 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, check us out online at wealthwayadvisors.com. All right, talk about last-minute planning issues that you can do before the end of the year. And before the break, I was talking about some strategies you can employ if you expect your income to increase in the future. Those of you still very much in the workforce, that applies to a large segment. How about the opposite? How about those who expect their income to decrease in the future? Who would that be? Well, those would be some pre-retirees. If you're in the 0 to 5 year window to retirement, some of this might apply to you. So consider strategies to minimize your tax liability now when you are presumably in your highest tax paying years. So by making contributions to a traditional IRA and 401k or company-sponsored retirement plan instead of contributions to Roth accounts. Okay, this is when the higher your tax bracket, the more you want to get that tax break today. So for those of you late into your career, try to max out that company-sponsored retirement plan. I'll give you those numbers again. I came across something the other day. I think it's only about 14% of the U.S. population contributes the maximum to their company-sponsored retirement plan. The numbers are pretty big. They're pretty generous, so there's a lot of room there. Again, said earlier in the show, contribution limit this year, $23,500, but you can catch up another $7,500 if you are age 50 this year or older, for a total of $31,000. And there's a special catch-up to make things even more confusing. For those people who are ages 60 to 63, your catch-up amount, instead of the $7,500, is a bit higher at $11,250. So if you're age 60 to 63, your max contribution is $33,750 this year. Like first caller Alina sort of asked about, can I backload my contributions to my company retirement plan? The short answer is yes, if your plan allows it and your payroll department allows it. It's not an automatic, but it is possible under the tax code and law to go ahead and try to cram as much of your final paychecks into the company retirement plan as possible. All right, how about those of you with capital losses from maybe past years gone by? Took a big loss in 2022 when we had a significant market decline. Well, if you did take a big loss in your investments or any other asset that qualifies, and you were not able to use all of that loss in that tax year, then that loss will carry forward to subsequent years until it is used all up. But you have to keep track of it. You or your tax preparer must keep track of it. Now, if you're using software to do this, Quicken, TurboTax, or you're working with a professional, then that should be tracked for you. But just know it's you're responsible to track that loss, to keep it on the books each year. And if you don't, then you lose the tax savings ability. So they do have, the losses don't feel good at the time, but they do have a value in tax savings going forward. And then also, as I mentioned at the beginning of the show, even if you can't use it to offset similar types of gains, you can use $3,000 of it this year to offset ordinary income. And if you're in a high tax bracket, that can be fairly valuable. All right, that's about all the time I'm going to have for tonight. It is obvious to me that I have a lot more to talk about, year-end tax planning opportunities. So our next show will be in 2 weeks on Tuesday, December 9th at 6 p.m. as usual. And we'll have sort of segment number 2 of year-end planning moves that you can try to knock out here before the year is up. And then the last show of the year, that's going to be a pre-record because we'll be deep in the throes of Christmas time then. So until 2 weeks from now on December 9th, we'll see you then. I'm Certified Financial Planner Kevin Zivna. You've been listening to Dollars and Common Sense on News Talk 790 WNIS.